Everyone, welcome to the 140th episode of the Timing Research Show for June 5th, 2017. My name is David Kosmeter. I'm the creator of Timing Research, and today we will be talking about the 193rd weekly report. So if you haven't had a chance to take a look at this yet, just go to TimingResearch.com and you can download this or any of the past reports there. I have Rob Hanna back to moderate today, so I'm going to go ahead and turn it over to him.
Thanks, David. It's great to be back again today. Looks like we got some familiar faces and some new ones I'm getting to talk to today, so that'll be fun. I'll introduce the. Let me just go down the list of the group, and then I'll let you guys introduce yourselves and tell us a little bit about your work and your sites. We have Frank Fahey from OptionView.com, Anka Metcalf from Trade Out Loud, Sam Bourgi from TradingGods.net, and we are hoping that Glenn Thompson from Pacific Trading Academy might be able to join us as well. And again, I'm Rob Hanna from InvestorQuant and also Quantifiable Edges. And it looked like someone's popping in right now. That may be Glenn.
Hi, good morning. So I had a little issue getting in, but I'm here.
All right, great. No worries. We're just getting started here, so you didn't miss anything yet.
Great.
Let's start off by going through, and I'll go down the list just as I have it written here. So, Frank, I haven't gotten to speak with you in the past, so I'm looking forward to hearing some of your thoughts and ideas. Can you tell us a little bit about yourself and about OptionView?
Sure. I'm a consultant with OptionView. I'm the advanced mentor instructor on the Discover option side. I'm a power user of OptionView as a trader. I trade multi-leg positions. I'm a short premium trader. I started trading, 1984 as a member at the CBOE, and I was down there or and then the Board of Trade after 2005 trading wheat options. So I managed to survive quite a while down there. Once the markets died, I started doing consulting for the Options Industry Council, for a number of other competitors to Discover Options and OptionView. Peak 6 University, one of the first people out there I worked with, done consulting for multiple exchanges, the CBOE, BATS, the BOX, the MyX. So that's what I'm doing. Primarily, I'm trading right now. As I said, I'm a premium seller, and
okay,
the best of times and the worst of times.
All right, great. All right, well, thanks for joining us. Look forward to speaking with you more. Glenn, why don't you give us a little intro to yourself and Pacific Trading?
Sure. I've actually been teaching and coaching with Pacific Trading Academy, PTA, since they began the inception, which is, I guess, about almost 15 years now. I've been trading for about 36. I started my career as a broker, and I actually got into the industry by default or accident. I was had a completely different career trajectory, and then at 24 years old, through a series of circumstances, made a major shift. Got into the industry not, just as at that time, not knowing much, and ultimately entered Merrill Lynch's training program and became a licensed rep. A few weeks into that, or actually before that, but I realized that being a broker was not my passion, so I began a transition to learn about the speculative trading aspects of the business. Long story short, about 2 years later, I got my first trading position. I worked a commodities broker on Wall Street, ICS. So that's, and then on and on and on through the years. But to keep it concise, I'm a technician primarily. My own accounts currently, which I still trade, primarily Forex, short or intraday activity in the S&P or ES. That's primarily what I do, and I enjoy it, and it's over the years. And in terms of my consulting and coaching with PTA, primarily teaching the technical approach. I've worked with beginners, experts, everything in between. So yeah, that's a quick synopsis of what's brought me to this point, I guess.
All right, great. Thank you.
Sure.
Anka, how about yourself? Can you tell us a little about tell everybody a little about yourself and about Trade Out Loud?
Well, hi everyone, and thank you, David, for having me here again today. And thank you, Rob. And my name is Anka Metcalf. I am a professional independent trader for the last 14 years. My specialty is swing trading stocks and ETFs and day trading futures. I only day trade futures about 2 hours a day, and I do that at the New York Session Open. And I have a 10 plus years experience in investment banking. Prior to becoming a professional independent trader. I'm also the founder and CEO of TradeOutLoud.com, which is a trading education firm that is specialized in educating individuals how to day trade and swing trade equities and futures. We also offer signal service for day trading futures. I also run a managed accounts program, and my education is based on a proprietary trading system that is based on price support resistance, and I take into evaluation the 7 layers of support resistance correlated with trigger times on very certain times throughout the day, specific price zones where I look to buy or short or take profit. Chart synchronicity, also a strict set of trading rules and a 10-point scoring system that I respect for many, many years. I have been respecting this 10-point scoring system at least for the last 20 years that I have been trading.
All right, terrific. So it sounds like you're doing quite a bit to keep busy there.
Mm-hmm.
The one thing I find interesting, I just wanted to ask you briefly. You mentioned you trade futures for about 2 hours each morning, and then
Yeah.
that's your focus with your.
Yes, I only trade the New York Session Open. Sometimes I look at the 2 commodities that I have on focus, and I trade I only trade 6 symbols. I trade 3 E-minis. That is the S&P 500, the E-mini S&P 500, E-mini NASDAQ, E-mini Dow, and I also focus on only 2 commodities, and that is oil and gold and the 30-year Treasury bond. That's pretty much everything that I trade. So I have a very, very short watch list.
Yep. Yeah, a lot of the intraday traders that I work with and familiar, come across over the years, focus more on the open as well. And I'm guessing from your standpoint, is it only because that's the more volatile, more reliable time of day, or is it a lifestyle thing also? I know some guys prefer the end of the day.
It's not about the lifestyle, because I swing trade, so I'm pretty much in front of the computers on and off so after I'm done with the day trading, I'm pretty much in front of the computer until 4:30, because I do have active swing trade positions. The reason why I am focused on the first 2 hours is because of the volatility. And for me, it is the sweet spot. It is the overlap of the London session with the New York session that promotes better price action. And I do have my specific trigger times that give me better opportunities correlated with the price zones that because I only watch 4 price zones, and if they line up, I trade between 1 and 3 trades. For instance, today I only had a trade in NASDAQ. That was long, obviously, and I literally, after it hit my target 1, I had my stop at break even. So there's very less volatility today. Most of the European markets are closed, and that's one of the reasons why we're having this really quiet day, and also very low volume day.
Yeah, it's funny. The volatility obviously is the biggest in the morning. I remember years ago when I was talking to some people, and they were saying, "Oh, wouldn't it be great to have a site for beginner traders?" We're talking about people that maybe have a full-time job that you could just trade during the lunch hour. Of course, the lunch hour has no volatility. There's no movement. There's no dependency.
Yeah, you know what is very interesting? Because if you would have been trading on Friday, and I haven't, so I was not in front of the computer Friday at lunch. That's when NASDAQ just popped higher, and we had the S&P 500. We had the S&P 500 may make a new high.
Right.
So yeah, so sometimes it works, but sometimes it doesn't work. So if we only knew in advance, that would have been fantastic. That would be fantastic.
Right. But from a reliability standpoint, I agree that the beginning of the day get you there more often. All right, I'm going off track here. Sam, I've been keeping you sitting there quiet for too long. How about telling us a little about yourself and a little about Trading Gods?
Well, that was a good segue into volatility, right? Since you guys mentioned it, I'll keep going. So my name is Sam Bourgi. I'm a markets editor for TradingGods.net. We're actively involved in the VIX market, looking at volatility as an asset and teaching traders how to access volatility markets through the ETF and the options sides. My background is in economic research. I spent 5-6 years in the technology sector, traded stocks there, moved into Forex, kind of stumbled into the industry by accident again, considering that I have a background in the research side, the economic side, and I found that I had a pretty good knack for entering the financial market, so I made a career out of it. But yeah, Trading Gods, we're mostly on the volatility side. Obviously, there's a huge market for that, and we're looking to teach traders how to use volatility as an asset in their portfolio.
Okay, great. And you mentioned you primarily do it with the VIX ETFs and options?
Yes.
Okay. You don't bother with the VIX futures at all?
Not so much. We found most of the real opportunities has been lately on the ETF side and the options side. So we also do look into futures, but mostly those are the two main streams that we focus on.
Okay. I imagine you use the futures a lot to determine, contango for the ETF trading. Is that correct?
Absolutely. Pretty strong state of contango in the market. It's been for a long time now. So
yeah, it's certainly helped XIV and its counterparts there. Okay, great. For those that don't know me, I should have introduced myself as well. I'm Rob Hanna. I've been trading since late 90s. Started doing it full time in 2001. I wrote for TimingResearch.com for a few years. In 2008, I started a site called Quantifiable Edges, or it was just a blog back then, and then I created a newsletter out of it also that same year. And it evolved into a website on its own. I still run Quantifiable Edges. I still have the newsletter every night. In 2012, I started a site called OvernightEdges.com that no longer exists, but it merged with Scott Andrews' Master the Gap site, and it's now part of, they're both under the InvestaQuant name now. And so I head up research at InvestaQuant. My main focus is with the overnight and swing systems there, although I do work with their intraday stuff as well. I've been doing a lot of research on that recently. So kind of getting my paws into more stuff now. But that's a little bit on me, and we'll talk more about that stuff later. Let's get into the market. Why don't I go in reverse order from the bottom up? And let me start. Let's just go quickly to find out where we all stand, I think. So if question one I'm looking at here, what direction do you think the S&P will move from this coming Monday's or today's open until Friday's close? And let me do question one and question two at the same time. Rate your confidence, and then after we kind of set the bars here, we'll go back and talk about reasons. So I know I always go last. Let me go first. I will say that I'm overall bullish on the week, although I don't have very high confidence in it. I am seeing some things from studies that I've done that are suggesting a mild upside edge this week, but there's not a whole lot. We've got momentum behind us, and so it's tough betting against it. From the InvestaQuant systems, we look at things out on a 1, 3, and 5 day basis. The 5-day is showing good odds. It was showing a 61% chance of a move higher over the next 5 days, with gains about 50% higher than losses in certain in similar situations. The 1 day was about break even. The 3 days is a little bit better than break even, but the 5 day looks pretty strong. So I will say I've got a 61% confidence in the fact that we should close higher on Friday than we opened today. So I'm one for the bullish case. Hopefully not everybody agrees with me. Let's go to you, Sam.
Yeah, unfortunately, I would have to agree with that. We hit a record highs on all 3 benchmarks on Friday. You said momentum is on our side. I do see about a 65% chance of us hitting higher this week. Okay,
great. Anka, tell us why we're wrong.
Yeah, I'm with you guys on this. 65%. I'm there with Sam.
All right.
I am mildly bullish, but I think the overall chart pattern is, although it's a little extended, but I think it does have a little bit of room to move higher. So, yeah, I'm a little bullish.
Okay. All right. Glenn, come on.
Well, I'm going to be your gift horse. I'm going to play the contrarian card here.
Okay.
I agree with everything and what has been said and what hasn't been said in all probability. Obviously, pure trend strength from a number of indications suggest higher prices between now and the end of the week. In fact, into the middle of the month. However, I've got some significant set of factors that I'll elaborate as given as we go forward.
I'll come back to you.
Yeah, I'm going to say down. Give it about a 77% likelihood.
Okay.
Even though I'm aware, and I certainly see, I think the easy projection is to say higher. But given I've got some extenuating circumstances that I'll elaborate on in a few minutes, I guess. But I'll give it about a 77%. What I can say with over 90% certainty, I expect this week by the middle of the week into the final into Friday to see a surge in volatility. So correspondingly, I've been suggesting straddle type scenarios in the indices, but I'll elaborate. But down and about 77% chance.
All right, I'll look forward to that elaboration because
sure.
I would. I think everybody is looking forward to a surge in volatility. For talking, Frank mentioned beforehand that there may never be. This is one of the most boring markets ever, and right.
I think it could be the quiet before the proverbial. You know what? We'll see. But anyway, yeah.
All right. So Frank, why don't you jump in? You can give us your take, bullish or bearish, and what's your confidence in it?
No, now you can hear me.
Yes, now I can hear you.
I'm a perma bear. I'm an options trader, so it's always been the downside that scares me. I construct my positions so it's benign to the upside. I make a little money, but I flatline to the upside because I understand I'm a perma bear and I have to protect myself from myself. But yeah, I agree with Glenn. I think we'll see an increase in volatility. I too have significant VIX positions. I trade the VIX options and I trade the futures at times as a hedge. And there seems to be support here where people are afraid to sell a 10 call or an 11 call or a 12 call front month. And of course that changes as time comes on. But I think while I'm bearish, I think we'll be flat to up. And I give that a 2/3, a 67% probability.
Okay. All right. So more likely up in your case, but worth protecting against. It sounds like.
I'm always protecting. I look at risk, and I've historically always made money to the downside.
Okay, that's interesting. You mentioned VIX positions, right? Or VIX options right now. So you're anticipating an increase in volatility. Is that how you're?
Yeah, an implied volatility. Yes.
Okay. All right. Well, if you'd like, I'll let you kind of go first and elaborate further if you have, if you want to expand upon that or other things you're expecting to see this week that might impact your views. technical standpoint or fundamental? Or
Boy, here I'm not a technician. I was my mentor on the floor used to say, "Hey, Frankie, every ship that ever sank had charts." So, I look at support and resistance. As I said,
okay,
they call us non-directional traders, but I'm a range trader. Right now, I'm looking intra-week, 2400 to 2465. And that's the first slice, first we do no harm. And I walk into risk and walk away from risk. I never put everything on red or put everything on black. I have a very large position that I need to feed on a daily basis. A little calls, a little,
okay.
I'm always adjusting the Greeks, and not always adjusting the Greeks. I'm always looking at adjusting the Greeks. But right now, we seem to have plateaued on the volatility to the downside. I mean, last week we saw the VXST, and Glenn can probably talk about that, go up significantly. People are wary right now. But to me, I don't know what can happen that'll drive us down other than the Fed saying they're going to increase interest rates 4 times, or some sort of massive terrorist response. So I'm not helping.
There hasn't been much bad news that has taken us down for more than a day or so.
No, well, there's no bad news. I mean,
Right.
we'll have today. We've had a 1/3% trading range.
Yeah, it's nothing.
The futures are 2433 to 2439. We are the most exciting thing happening in the market right now. I mean, that's a fact.
All right.
And it's ongoing. So.
All right. Okay. Thank you. So Glenn, why don't I let you expand a little bit more? You were
Sure.
you were the lone bear there.
Yeah. I like what Frank said, and I'll use it to segue into and continue the thought, but reaching a different conclusion. I like his, by analogy, no ship that ever, or all the ships that sank or whatever had charts. But so too did the ships that didn't sink, that made their arrival at the port or whatever. But here's I never want to confuse correlation with cause and effect. But let me get right to it. Again, as I mentioned a little while ago, I see clearly indications from a pure trend strength standpoint for higher prices. One of the chart manifestations I look at to give me a bead on the strength of trend and the likelihood of persistency of a given trajectory of a market is the size or magnitude of the pullbacks, and we're seeing relatively shallow pullbacks. I use a 66% degree of pullback as kind of the line in the sand or the threshold. By all accounts, from a price vantage point, I would expect a continuation of what we've been seeing for the last few weeks in the broader index. Here's the caveat. I've got a series of 7 cycles. My hierarchy of tools that I look at to kind of give me and derive the current status, and then I project that out to the future. Price number 1, a very close second is my timing. So I realize I'm in a minority of viewers here, but on the premise that a market's going to do what it's going to do once its time has come, and essentially this congruency of or cluster of cycles, all starting from last Thursday through tomorrow, the epicenter of which happened to be on the weekend. I had 2 cycles that have been tested. One is 60 years, going back 60 years. The other is 80 years. The 60-year cycle is 92% reliable. The other is 90%. Either one of them alone would be of interest to me. I'm not suggesting I'm going to establish positions based on a cyclical or a temporal component solely, but at minimum, what it causes me to do is look to see, am I seeing some price-based relationships that suggest a significant change, let's say, in the componentry of the system. So I don't know if, well, I can show you a chart, but just suffice it to say, for example, we've got some divergence showing up between some of the standard fair oscillators, your RSI, etc. That's an indication of, what I'm saying is the market by certain accounts is overbought. Yep. Yeah, it is. We're seeing a lull today. I want to, again, I give homage to the trend, which by all indications suggests higher prices. What I'm betting is, because I rarely see this magnitude of powerful cyclical evidence amassing in aggregate in such a relatively tight window of time. So I'm suggesting the possibility that that could serve as a trigger or a driver or a catalyst, whatever, to precipitate a major change. I'm also, and the reason I'm still, I'm not increasing my likelihood projection of an outright 180-degree shift of trend is one type of change can be manifested as more or less a continuation, albeit maybe in a different velocity. In other words, maybe we could by next week be at significantly higher prices and achieve those higher levels just at a slower or faster rate. So that is, I admit, one alternate type of change possible. I'm going to assume, and here's why. There's a very specific reason, because I wrestled with this all last week as we moved into Friday's close. What is the question I asked to myself is, what was the trajectory? What's the direction of approach as the market reaches the epicenter of my cyclical time components? Is it going up, down, or sideways? There are only three possible generic answers. It's going up. And we're, the last, I think before let's just see, I'm going to check my screen here. Yeah, we are still rising in today's session overall, establishing, I think, well, I don't know if we hit a new high. We're 2439 in the June front month S&P, but if we were coming down, I would be interpreting that as the obvious reversal implication, which would be to go to the upside. But we are, as we kind of meet this, as the price action meets the time component of the system, my best assessment is it is going up. Therefore, the most blatant and obvious type of change would be an outright 180-degree shift. So that's my primary factor. That alone, as convincing as it is, again, given the 7 particular, all different cycles, the lowest, the one which has the lowest degree of reliability is coming in at about 70% to 90% at the extreme. Any one of them by themselves would be important. The fact I've got, again, from last Thursday through tomorrow, 7 separate cyclical indications, more or less congruent given the broader, looking back the last few months, that is a strong argument in my estimation for what I'm going to interpret as an outright shift of given the fact that the last few sessions we've been rising. If we had been falling, I'd be bullish. But since we were rising into this point or window of time for which I expect high probability change, I'm going to expect it to manifest as a downside move. That's my primary factor. As far as fundamentals are concerned, yeah, the market is, I guess, this week as we move to the middle, or actually starting tomorrow, I think globally, and I'm not a fundamentalist, but I'm not oblivious to fundamentals. I know that there's some, the ECB, I think on Thursday, the Australian National Reserve Bank, there's some policy or interest rate policy meetings later in the week. The elections in Great Britain, it's not what I know that scares me, it's what I don't know. So yeah, we're going through a period of quiescence right at the moment, let's say, information in terms of information release. At any moment, my concern is what's brewing under the surface information-wise that could serve as a container of energy sufficient to possibly create a significant deceleration of current trend. And anything, I wrote a report the other night for a website I contribute to where I said, take a look at the usual, or consider the usual suspects, anything economic or political in particular, especially with the scenarios going on in the U.S. Political scene. But again, the primary factor that creates that forces me to pay attention to my bearish view is the fact that we're overbought. It by itself is not sufficient, but the fact that I'm seeing some indications of trend reversal at the time, consistent or congruent with this time cluster, is of importance to me. That's why. Yeah.
Okay. So it's the overbought nature plus the cycles coming to their normal end. Suggest
the fact I got 7 different cycles. The two most important came in curiously on the weekend. So how do you interpret something that happens when a market's not trading? Well, you look at the surrounding points in time. The fact that for the most part the market is reaching what I could be, we'll see in retrospect what the precipice of the move in this kind of central component on the time. Essentially what I'm saying is I'm conjecturing the possibility the market may have run out of time for this current regime, allowing for the onset of an altogether separate type of price regime. Yeah.
Okay. Interesting. I don't do much cycle work myself, but I have some friends that do a lot of it. Tom McClellan's a guy that I've been friends with a long time. He does a fair amount of cycle work, and he talks in terms like you're talking about sometimes too, where he'll say, well, we got a bottom, but I'm not sure if it's going to be a bottom that is a reversal bottom or a bottom you just come up out of.
Correct. Is it a period of consolidation out of which, when it breaks out of the range of consolidation, it essentially is, in a figurative sense, moving in from one neighborhood of price behavior to an alternate one. Right. And that's often attendant with changes in, like I think Frank said, an increase in IV, etc. So, yeah. Again, it's not I see everything that everyone else has seen in terms of the pure indications of trend strength. And my hesitation, why I didn't come in at a higher degree than 77% likelihood, is I want to. There's a possibility I could be interpreting this incorrectly, and the trend has a further life left in the current regime. We'll see. I think in the netting out and resolution of all these vectors, I expect that we could be caught off guard. And curiously, from a contrarian standpoint, the fact that there are still the fact that there is such a degree of bearishness out there is a reason why I am somewhat more bullish. If it weren't so, I'd be, I think, even more bearish. The fact that there's, so.
All right. Well, interesting. Thank you, Glenn. Anka, let's get to you, and you can tell us in a little bit more detail some of the things you're seeing that are making you lean towards the bullish side for this week, and if you have any thoughts on things that could change your mind during the week or things you're looking at, that'd be great to enlighten us on as well.
All right. So what I'm looking in the market right now is the fact that literally every single time, and this is something that we have learned since early 2016, is that every dip was bought. And we looked on the chart. We looked pretty much on pullbacks to the moving averages. We looked at pullbacks to minor support areas, and that was the case every single time. You look at a chart and you go back in time, all these dips were bought. So even if we're going to get a pullback, the pullback areas that I'm looking for, if we're going to get a shallow pullback, I'm expecting to be bought again at 2418 level in the SPX. Also, if we should get a steeper pullback, let's say to the 2400 psychological area, we also have a 20-period moving average there. Strong area of minor support from these prior highs that were set on the chart. So this is a very, very strong area. Not a lot of extension from the 2400. If we might come in more from that point on, I'm going to be looking at this area right here. So we have a cluster of congestion very close to the 2375 area. But so far, because I've mentioned the fact that I'm bullish, I do expect for the market to continue higher. And what we know is that so far we have somewhat of symmetry. And after a breakout or breakdown, we had at least at least 3 to 5 bars to the upside before the pullback occurred. Also, there's very strong, because we've been talking, and I think that Frank was talking about the VIX. Okay, I'm just going to bring the VIX right here really quick. Okay, and there is a strong symmetry on the VIX, so I'm going to go to the daily chart here since my screen has shifted a little bit, because we're talking about symmetry. And I think that, yes, every single time you could see downside, downside, downside here, shallow and then a spike to the upside. So this is the abnormal spike, but then we had symmetry that continued throughout. So I'm expecting for the market to go up at least until the VIX are back into the $11 area, and that's when I'm going to look to be a little bit bearish, and that's when I'm going to look to tighten my stops. So far in NASDAQ, we've seen today that we have new high in NVIDIA. We have a new high in Microsoft. These are like the power stocks that are moving and keeping the market up. We have new high in Facebook. And all in all, we have new highs in a lot of stocks today, even on low volume. So they continue to rally throughout. So my bias is that technicals promote the fact that we are going to move a little higher. And again, I believe it was the gentleman that talked before me from Pacific Trading. I don't recall his name, but he was mentioning the fact that this, yes, sorry about that.
That's all right.
He was mentioning a very important factor to consider, and that is the news element, the economic release element. This week, quite a quiet environment for the U.S. markets, but we do have some overnight movers that we're expecting. The RBA, we have the ECB, and I think this might be the quiet before the storm, before the volatility is going to really start to kick in next week with the FOMC. I mean, and I think that we are going to get a rate hike, and this is my personal opinion, because usually when we look at these rate hikes, you know, when we think about it, I think it's less likely that we're going to get a rate hike in December, and I think most probably we're going to get a rate hike this summer and this fall, because this year we're due for 2 more rate hikes, and I think that this is going to start moving the market a little bit higher, and maybe the financials are going to start to power up. What's really worrying is that when I look at the market and when I look at the market conditions, I always look at the financial sector, and so far this move to the upside is not really sustained by the financial sector, and this is probably penning on next week's FOMC meeting.
I'm sorry, I missed that last piece. It's what on the FOMC meeting?
I think it's pending on the FOMC meeting.
Pending. Okay.
Yeah. I think it's just waiting to see what the FOMC reaction is going to be. Right. And it's only logical if we're going to get a rate hike. Probably the financials, it may be seen as good for financials, if financials might be starting a new cycle to the upside. Because the way they are right now, they have been basing, they have been ranging for quite some time. So they're due for a move, either to the upside or the downside. No rate hike. My bias is that they might continue to trade sloppy a little bit, probably to the downside. But if we get a rate hike, I would say that probably we're going to get a little spike in financials, and probably the market is going to continue higher as well.
Yeah, and financials are obviously directly impacted by the rates, and so people not making strong bets on them this week or and early next week, leading up to the Fed meeting, is totally reasonable. And then they could see the strongest reaction after that, right?
Mm-hmm. Yeah, this is the XLF right here, and you can see that it has been basing for a long time. So we can see here that since December 8th until February 10th, we have been ranging. Then we had the spike up, pull back into the same area here, the $23. So I think it's due for a little push to the upside if we're going to get a rate increase.
Right. Okay. All right. Thank you, Anka, very much. Sam, you've been quiet.
No, I'm deciding whether I change my mind or not after listening to everyone. It's been very enlightening. But no, for me, look, I am bearish long term on this market. It is the second most overbought market ever. It all depends on when you think the meltdown is going to happen. And in my opinion, it's not going to happen anytime in the immediate term. This week, volatility closed on Friday at nearly 24-year lows. There's not a lot on the economic data front here in the U.S. we've been buying the Trump rally on, and as Anka mentioned, financials are due for a breakout soon as well. I think financials have been the second best performer on the S&P 500 since the election, and they're definitely going to raise rates next week if you look at the Fed fund futures prices. So that's pretty much almost priced in right now that it's going to happen. So I think that in the immediate term, it's going to trek higher. If I am going to be a contrarian, one thing that I'm really going to be looking at is the UK election. Now, I'm looking at public opinion polls, and the Conservative Party is going to actually lose ground in the House of Commons based on the latest polls. So if that happens, that might complicate the outlook on Brexit, what's going to happen there. That might trigger some volatility and uncertainty, beginning in Europe. So if the market is going to take a dip this week, that might be an event that really kickstarts it, because what happens if the Tories end up with a smaller government? How is that going to impact the Brexit scenario? And Brexit enough is giving us enough uncertainty as it is. So that's one area that I'm watching that could tip it back in the other way. But ultimately, I think people are still overall optimistic about what the new GOP administration in the U.S. is going to do. So I don't see much downside over the next few days, of course, depending on what happens over in the UK.
Yeah. Yeah, a lot of what I'm seeing is I'm with you guys. Momentum is an interesting thing. I looked at a study this weekend. It's an old study that I've looked at for years, and it used to suggest when we got this overbought on a short-term basis, what the study did is it looked at SPY prices, and it said if you closed above the 5-day moving average, it was a very short-term moving average, for at least 10 days in a row, and at a new 10-day high, that's a suggestion that you're overbought, and looking out at 1 or 2 or 3 days, it suggested you were due for a pullback. But starting around, and that was from like mid-90s to about 2013. But since 2013, it hasn't held true. We've been in this market that momentum has been able to carry for longer and for better, and so there was no longer a downside inclination since 2013. In fact, there was a slight upside inclination. So I'm not, we're definitely overbought. I don't know if it's going to matter, but I do think the Fed meeting coming up next week is going to be something that people may start to worry about as we get towards the end of this week and into early next week. So that could translate into some profit taking. It could also translate into higher VIX. And then from there, if the market does what it's been doing, what we'll see is we'll probably see a rate increase, and then the unknown becomes known, and the VIX comes back down, and the scared, it's kind of the sell the rumor buy the news type thing, where, oh no, are they going to raise rates? And then they do, and it goes back up. So we may see that type of scenario, but like I said, I'm looking to go higher this week, mostly on momentum and the InvestQuant systems. We're looking at 5 days. They look at momentum, acceleration, and seasonality. And when you break it down that way, momentum is looking strong. Seasonality is actually looking quite strong as well. Acceleration is showing the overbought and not looking as good at this point. So that's where I am with things. Let's go on to question, what is it, number 4, which is an interesting one this week, talking about position sizing. And I know this will probably be different since we got a lot of different kinds of traders here. We've got swing traders, option traders, VIX traders, Forex. We're looking at intraday. We're looking at swing type positions. So there should be a little bit of everything from people, I would think. I'll mix up the order a little bit, and let's start with, say, Glenn. The question is, when you enter a trade, how do you decide on your position size for that trade? For example, do you set a dollar amount, a percent of the account, confidence in the signal, or some combination of those things, or other factors?
No, from a theoretical standpoint, I guess, just to give you a context, years ago I read and studied utilizing some sort of Kelly fraction from the Kelly criterion.
Mm-hmm.
What I typically do and provide as a suggestion to people I work with, I start with a percentage, typically no greater than at a maximum upper threshold about 15%. And then work on down, and then I integrate my degree of confidence or expectation and modify, but usually it's about no more than 15%, and then I adjust that. That's one kind of model or idea that I use to kind of hone in on an appropriate size. And the other way I do it—
I'm sorry, is that for, I don't mean to interrupt, but
sure.
You do intraday trading, a lot of that. Is that also for?
Also for a position. Yeah.
Positions. Okay.
Swing trades. Yeah. No, whatever it is, it should not exceed it as a gross kind of determiner or indication of trade size, no more than 15%. And I would stick to that kind of level or trade sizing determiner about 80% of the time. There are 20% exceptions, but I'm going to be a little above or below, but usually that's in the ballpark. Another set of relations I utilize often to kind of determine, and I do this a lot in Forex, I look at the level of resource, how much money the trader has or I have available in my accounts. I want to establish at least a 2-to-1 reward to risk. And so that by adjusting, given or playing with the two variables of level of resource equity and then looking on the charts and seeing if I'm long, where the relevant zones of support are, and vice versa if I'm short, where would if money is not an object, if it doesn't matter in a utopia, where would I put my stop, let's say, and then adjust that, and that in turn spits out the trade size for me, the number of lots or units or shares or whatever your minimum increment of participation would be. That's another kind of relationship I look to kind of approach and approximate a valid, relevant trade size.
So in that case, you're saying, I don't want to risk more than, say, X dollars. How far is the stop going to be away? So if I want to, be 10 points away.
Yeah, given the amount of, and given given the taking into account the value of each point, that will determine the number of positions you can go in, and still at the same time ensure a good reward to risk. And so look at that, you're kind of backing into your trade size. And as long as that, at the end of the day, as long as that's not exceeding now, trade sizing, one variable is the question. The other issue is I want to make, but you want to consider it in light of it, and it's equally important in a different way. Risk, where's the threshold of adverse price action relative to your position, beyond which your priority shifts from one of allowing and giving the opportunity for your tools of analysis and your projection to pan out and manifest versus capital preservation required for the future. So you ensure that you have odds sufficiently high for future episodes in case you experience a realized loss in the current transaction. You want to make sure at the end of the day, when you exit that losing situation, there's funds remaining sufficiently, a sufficient amount of money to ensure you have enough to do a sufficient number of trades in the future so that the odds are skewed so you can recoup that which you've lost and then some. So that's a complementary kind of consideration. My trade size is juxtaposed with my risk threshold, and the risk level should be considerably smaller. Again, I usually come in at around 3% of total equity, but trade sizing no more than 15%, about 80% of the time.
Okay, excellent. Thank you.
Sure.
All good stuff.
One quick point on what you were saying about the seasonality. I saw a study last night to kind of support my view. It said, pertaining to equity indices in the U.S., going back like 50 years of data, and it's purely a seasonal component. When the stock market, I don't recall if they were talking about the S&P or the Dow, but they were saying when the stock market from June 1st to June 13th for the last 50 years, when it's over its 200-day moving average, 79% of the time it declines by the middle of June. excuse me, it moves up. Right, they're wrong. When the when the market starts at the beginning of June, as you enter into June, below the 200-day moving average, it has the opposite behavior. 79% it declines if it's trading already as you come into June above the 200. 61% of the time it declines. So interesting seasonal idea. I just wanted to mention.
Yeah, that's interesting. So it tends to whatever
Where
momentum
that,
it's
so
got,
by
whatever
that,
momentum's got coming in, it carries into the beginning of June with.
Yeah, by that reckoning, yeah, that would be bullish. Yeah, possibly. Clearly, we're into the middle, and it corresponds almost the 13th. I think the Fed meeting is the middle of next, whenever the 15th is, next Thursday, I think. So. Yeah.
Right.
Anyway.
Hey, there's always enough crosswinds to keep everybody interested, right? Even a boring market like this one, huh, Frank?
Definitely. Does that mean I'm next?
Yeah.
Okay.
So the question is, again, when you enter a trade, how do you decide on your position size? Set dollar amounts, percentage of accounts, confidence signals, and I imagine yours is a little bit more complex than some other people since you're a big options trader.
Well, actually, it might be simpler because I learned my success comes from reducing things to the lowest common denominator. I was talking to Dave before, and my whole approach is trading options is long periods of boredom interrupted by moments of panic. And quite frankly, we haven't had panic since the night after Trump was elected. And so I sit there and look at risk. And I've mentioned that before. As a market maker, as long as I had a penny in my account, I was still in business. The clearing firm would let me trade. They might suggest that I reduce size. But my window is longer than many other windows here. I'm not intraday, I'm intra-month. And the bulk of my positions right now are in E-mini options and futures out in August and July. And I'm already looking at, I'm taking off July positions and putting on September. I don't need a whole lot of movement. I'm a remora swimming in and out of the mouths of sharks. So what I do does not attract Goldman Sachs interest. They're not going to get in my way. So I look at change in price, change in implied volatility, and change in time and how they impact my positions. I walk into risk because, as we were talking, if volatility goes up, I've put on stuff. Since I'm a seller, I sell Vega, which is implied volatility, the Greek that measures implied volatility, and I end up short Gamma, which means when we go down, I get longer, and when we go up, I get shorter. Now, as I mentioned, I deadline, I flatline the upside to protect myself. So I'm probably about 3% in highly leveraged accounts, meaning, you know, we have span margining, we have portfolio margining as opposed to Reg T. And so I'd probably be 1.5% Reg T. I'm always in there and going, what if we go up? What if we go down? If I say that can't happen, then I go, okay, my experience of 30 years of trading, standing in the pit for the crash, standing in the pit rock, well, when, you know, the Discovery went down. If I say it can't happen, it's going to happen. And I've managed to lose money every way you can. And that's what being in the business for 30 years or trading professionally for 30 years has taught me.
Yeah, you see it all.
Oh, yeah. I mean, I've had my face ripped off more than once. So I try to keep it from happening again. I don't want to finally have to get the slow learner tattoo across my forehead. And, so I have a different approach. I mean, I'm risk-based, and I love listening to all you other guys because that's what I need. It tells me the what ifs I need to ask.
Yeah. Because
people listen to you, and I'm not saying you're wrong. It's not what speaks to me in my trading style. But I walk in, I walk out, and since I'm an option trader and sell premium, I have to adjust so that I'm not buying premium at highs when I close.
Okay.
It's a dance. So I always have to preserve capital, as other people have said, but mine has to have the staying power to avoid those explosions. And that's why I do things like buy butterfly, call butterflies in the VIX. You know, if we have an explosion, I'm covered a bit to a certain level. So
okay, interesting. Thank you, Frank. Anka, how about you? When you enter a trade, how do you decide on your position size for that trade? Dollar amounts, percentage accounts?
Yeah, I keep it very simple. So first off, I have a determined amount that I risk on every trade, whether it is a futures trade, day trade, or whether it is a swing trade, whether it's in stocks or ETFs. So I'm going to give a quick example so all our listeners can understand. So let's say I have to determine my risk tolerance. So what can I afford per day? And that is in strict correlation with my account size. So all in all, I would say that beginner traders should never lose more than 1% of their account size, or never risk more than 1% of their account size on a trade. However, because of my batting average and my prior experience, I go as much as 3% of my account risk per trade, but I don't go over that. So let's say, hypothetically, if I have, let's say, $200 that represents my risk tolerance per day, knowing that I take, let's say, 2 day trades a day, and let's say 2 day trades, futures trades a day, and let's say I can take a swing trade a day, I have a risk tolerance of $500 per trade. So all in all, I could take 4 trades in that day by respecting my $2,000 risk per day. And this is every day. So what is very important to notice is that you have to have the risk tolerance that you need to meet per week. So mine is, let's say, $2,000 times 5. So that's $10,000 per week. But again, this comes from a very tight money management that I do, and I do have rules in place that enable me to lock in profits as soon as either my mini or my commodity or my stock or whatever I'm trading reaches my target 1 level. I immediately bring my stop as close as possible to a break-even level, or if I have another sustainable support area because I'm a technical trader, that's where I'm looking to lock in profits each time. So when I determine my position size, obviously I take into consideration my entry and my stop, and the difference between the entry and the stop represents my risk. And then I go into, let's say, into position sizing mode. And let's say if I'm trading a stock like NVIDIA, and if I'm having, let's say, a stop in NVIDIA that is, I don't know, 1,000, if I have, let's say, if I want to take the trade with $1,000 risk, and if I have $1 stop, then I take 1,000 shares. Yep. Same with Facebook. Let's say I want to take a trade in Facebook and I have a 55-cent stop. Well, then I position size to my risk, let's say, to $1,000, and then I could take 18,000 shares of it. So it's in strict correlation to the difference between my entry and my stop level, and also the reward level. But we're not going to talk about the reward level here, which has to be at least a minimum of 2-to-1 or 3-to-1 compared to the risk. And I think position sizing and risk management go hand in hand. And I think it's very important for traders to, and I've learned this, let's say I've learned this the hard way, because I was one of those traders that, let's say, I was trading on intuition, and that was many, many years ago, probably more than 20 years ago. So when I would take a trade, I would have strong feelings about, let's say, right now, the XLF that is going to go higher if we're going to get a rate hike. And I would favor that trade more than, let's say, going long oil futures. And I would take different kinds of risks. So I would say, let's have a risk of $1,000 in the XLF and have a $500 risk in oil, let's say. And that's not good. It doesn't add up, because when it comes to trading, you have to achieve consistency, and consistency you achieve only by respecting the same risk per trade. Position sizing is key into killing or growing your account. So you can grow your account with position sizing, but definitely if you do not use it, if you do not know how to use position sizing, this is going to kill your account for sure.
Okay. Thank you, Anka. Good detailed answer there. We are getting near the end here, so I'm going to have to speed up a little bit. Sam, could you give us a little insight into how you decide on your position size for trades?
Yeah, very quickly. I mean, we teach this in the VIX Trader program. We decide to, I mean, our approach is very conservative and defining the amount of risk. We look for, low risk and high probability of success for each position that we take. On the ETF side, we have a 5% allocation of our total portfolio on any position. And when it comes to the option side, again, we also maintain a very conservative approach. All this is rooted in our 4 easy trading rules that we teach to traders, showing them how to determine an entry point, determine their stop loss point, how to confirm their trade with a technical indicator, and then how to set it up and manage it, and then ultimately also gradually scale up when it comes to the option side, if and when necessary.
Awesome. Okay. Thank you. I'll give my quick answer here, and then we'll do a little wrap up, and I'll let everyone go. For me, it's kind of a combination of my confidence in the signal and a percent of the account, and what I'm overall risking. So similar to what Glenn was saying, depending on the type of trade, if I'm doing a index trade, I generally trade those with higher sizes because they don't have the same amount of volatility as an individual stock or maybe a sector ETF. And I don't expect the same type of movement in them, so I can afford to take higher amounts of capital. And additionally, whatever my confidence is, I might start saying, all right, well, I would take a 10% position in this, and if I don't love the trade, I think it's a decent one, I might take a 5%. And if I absolutely love the trade, I might up it to 12% or something like that. So very similar to what other people were saying. The one thing that I think I should point out is whatever your approach, you need to make sure it matches you from a psychological standpoint. There's a lot of position sizing algorithms out there, like the Kelly criterion and other things, and they may be able to maximize your growth if you stick to them. But what happens is once people get into a drawdown, it becomes very hard to stick to them. So really, I've always believed that the ultimate position size is whatever you can up to the optimal. So if you say Kelly's optimal, it can go up to that, but it still should not go any higher than you can comfortably trade. If you are going to bail on the trade early because you get nervous, then you shouldn't be in a position that big. You got to be in positions that you're not nervous, and you can just take them and let them ride.
Hey, Rob?
Yeah.
On that, can I just interject an important point since you raised it?
Sure.
As far as, like, say, theoretically, the Kelly fraction is the optimal, but that's assuming we're living and trading and sizing in a vacuum. It is
right.
Optimal, but consider the path by which you achieve a given optimal. It's laden with high volatility. So you should theoretically, and I tell this to everybody, just as a generalization of this, take a look at whatever your model is, Kelly or other.
Right.
If whatever the optimal is, then tune it to your equity level, because what good is an optimal trade size that is slated and determined and derived for the purpose of generating a maximal nominal return if you never get to that return because your drawdown, given the level of equity, is not sufficient? A trader with 100,000 might do an optimal or 100, whatever millions in a 6 or 7 figure account could sustain and live by an optimal Kelly or whatever the model might be. A trader with 5,000 might theoretically on paper realize that, but never actually realize it because their drawdown in the interim to get to that, he would be wiped out. So you got to consider that. So in a generic sense, that's how I'd look at it. Yep. I think, whatever tune your optimal model to determine an appropriate valid trade size and take into account your level of equity. And I utilize Kelly as a starting point, but I adjust it. Typically, they've done study after study that show if you reduce take a fraction of Kelly, you reduce the volatility. Yeah, that's what you gain. The price you pay is you lose some of the percentage return, but it's better to do that. You can survive for the next day, creating a distribution of outcomes. Whereas if you just go by the optimal on paper, if you have equity to support that, great. But if you don't, you will never see that theoretical optimal realized. So tune it to your parameters, i.e. the level of funds available, and your emotional tolerance is another factor also. Just thought that was key.
Yep. Yeah, that is key in addition to the emotional tolerance. Okay, we'll go down the line. Just if you guys could give a quick, let us know if there's something going on at your site right now that you want to tell us about. If you have a trade idea for this week, I'll start. So unfortunately, I don't have a great trade idea for this week, but we're kind of in that overbought area where I'm waiting for a pullback to get into. So if we get that, Fed anxiety pullback at the end of this week, early next week, I'm guessing that's going to be a viable pullback for me. And so I'm waiting for that. I don't like buying into a market that is already overbought and has been for several days from a swing trading standpoint. I'd encourage anyone that wants to learn more about my work to visit investquant.com. You can take a free trial of my Navigator swing newsletter there. You can also check out, I'd very much encourage you to go to Quantifiable Edges. We have a special right now. I am doing it's a special I've never offered before. I've written a lot on Fed days and action around Fed days. I did a book several years ago called The Quantifiable Edges Guide to Fed Days. And that, along with my Fed Day code, is currently being offered if you make any donation to the Multiple Sclerosis Society. I'm doing a ride in 3 weeks for a friend that was diagnosed with MS, and I'm supposed to ride 175 miles. And I just bought my bike a couple weeks ago. So we'll see how that goes. I'm starting my training, but make any size donation. Just go to quantifiableedges.com, look at the blog from last week, and you have all the details there. And anything will get you all my best Fed Day work. Sam, why don't we go to you? I'll just go up my list here. Tell us anything you want about tradingguides.net, or if you have a trade idea for this week, that'd be great.
Sure. I mean, no trade ideas right now from me, but we do have a VIX Trader program available at tradingguides.net. Anyone interested in trading volatility as an asset, whether on the ETF side or the option side, come check us out. We have a program designed for you.
Thank you. And those of you that have been listening, I think we've got quite a few smart people on this panel, so I would suggest you check out any and all of their work before I before I say goodbye here. I just want to put that in there. Anka, anything you want to tell us to finish off here about Trade Out Loud, or you have any trade ideas for us for this week?
Actually, I do have a few ideas, and if you guys want to follow me, if any of the listeners today would like to follow me on Twitter, it is twitter.com/tradeoutloud. We post free trading ideas over there for swing trading. We also give some ideas for futures as well. One of the trades that, and I'm going to take really quick because I'm going to share a screen right now. So I do have a few trade ideas, and I want everybody to take a look at. There might be good trades coming out of this. Keep in mind, this is the XLF. We have been looking at at XLF for some time. I would love to break this $24 level. I'm also looking for an early entry over $23.70. My stop is going to be under $23, and I'm looking for a continuation, obviously, into the top of the range where I'm going to consider my target one level, and I'm going to look for further follow through into the $25 level. Also correlated with XLF is Goldman Sachs. Goldman Sachs that has been basing for a long time right here for actually 4 trading sessions at the 200 moving average. I love this consolidation, and I think over $215.50 is ready to go a little higher. And I'm looking for targets into the 225 area, 230 area, continuation higher, most probably for a medium and longer term back into these highs into the 250. And one more that I have right here is JD. And remember, all these trades are mentioned on our Twitter account as well. JD. Powerful run to the upside, new high 41.97, pullback right into the 20, into this cluster of support right here. We see a trade over $40.50. We see a stop below $39.65 and potential to run into the $41.50 into this prior high, and further projections for medium and long term into the $43 and $45 level. If you want to hear more about our education or our active signal services, trades that are delivered real time before they trigger, obviously, visit our website. It's tradeoutloud.com.
Excellent. Thank you, Anka. Glenn, let's go. Actually, if you can see the link, I just shared the Fed Day research link that I mentioned for MS. All right, now on, I want to get to Glenn and Frank to give us your kind of last trade idea and anything you want to tell us about Pacific trading.
Sure. As far as just a very basic and relatively innocuous strategy, given my expectations for rising IV this week in the equity sector, I would be doing basic vanilla straddles, and I've been suggesting that since last week. So buying at the money strikes, going out about 2 to 3 months in the equity in any of the major indices, I think would be appropriate right now. In addition, and I think it was Sam who mentioned this, the fundamentally, and from an intermarket standpoint, the election, the parliamentary election in the UK should be of interest, and combined or followed by the policy meeting concerning the ECB later in the week, I think. So I'm paying particular attention from the Forex sector and the Euro USD. Last week we broke out above key resistance. I expect further appreciation. We're trading right now at about 112.56 area. 1267 is resistance. Assuming we can break through that, and I expect we will. And again, it does depend, as everyone has agreed, a lot on what happens next week with the in our FOMC, but more directly concerning the policy meeting this week with the Draghi and ECB. I expect we could see easily the 113 area in terms of our overhead target in Euro USD. So that any strategy that would exploit further expected appreciation in Euro prices, I expect is an idea I like. There are a multitude of strategies, but immediately the most direct trade for the present, I like straddle type structures in U.S. equity markets right now. For those who would like to get a little clarification on some of the programs we offer at PacificTradingAcademy.com is the site. I primarily focus on well, what I don't focus on is less time. I do everything. I teach everything, and other than the fundamental approach. Ironically, I started my career there, but I haven't done or focused on fundamentals for many years. But I'm primarily the technical person. We have some of my coworkers teach the fundamental, quantitative, but my paradigm is the technical approach. So I work with beginners, experts, everything in between. I do a little options trading. I like what Frank had to say in terms of volatility, and so I'm always comparing IV with future or projected volatility, and that's where I look for mispricings and option instruments, and then I look to hedge it when I do that. So all of the above, again, the exception being I don't teach because I'm not set up from an infrastructure standpoint to get into the fundamental aspects of things. I've just never could figure that out. So I found when I began to more greatly incorporate a technical thesis into my analysis, it gave me a sense of more plausible, probable scenarios. And then when I saw fundamental events begin to bubble up out into the real world, I looked for alignments there. So that's the idea and the approach that I take. So again, anyone that might be interested further in what I do and how to do it, check out our site. Again, PacificTradingAcademy.com. Happy to give you more insights. Thank you again.
Thanks, Glenn. Good to talk to you.
Sure.
Frank, you got the last word there.
Oh, that's scary. But thank you very much. One thing I would like to give you a tip of the hat about the comfort zone. The risk-reward comfort zone is probably the most important thing for a trader, whether it be equity, index, or options, futures, to develop. You have to learn that. And as part of that, I think it's very important to develop a dollar risk or dollar profit goal. I see too many people mask that with saying, I want 5%, and they lose sight of the dollars. Moving on from there, OptionView International is two different businesses. One is Discover Options, which does the training on options, and it goes from beginners all the way through fairly sophisticated expert levels of trading. None of this training is good without a good tool, and Discover Options is what I use. And I have access to other people's software. I should say the OptionView risk analysis software. I'd recommend it highly. Go to optionview.com and you can get a test drive on it for 30 days. It'll allow you to analyze the risk very well and to go through multiple iterations of what if. They have a tool that allows me to superimpose what my risk alternatives or reward alternatives are. So that's optionview.com. If you have any questions, I'd be happy to answer them at fjfahey@gmail.com. Just don't stalk me, please. Thank you.
Thanks, Frank. It was great getting to talk to you as well. All right. I think I went a little long here, but I apologize, David.
No problem. Good show.
Hope everyone enjoyed it. I think we had a lot of good input from all the guests. So
yeah, definitely.
Yeah, it was good.
So just want to remind everyone watching, be sure to hit the YouTube subscribe button if you haven't yet, so make sure you get updates on future shows. Also, be sure to join us next week, June 12th. Kurt Capra, Fausto Puglisi, John Netto, Simon Klein, and Matt Buckley will be on that show. And if you would like to get any of the past reports or view any of the past shows, just go to TimingResearch.com. So thanks, everyone.
Thank you, David.
Awesome. Thanks, David. Thanks, everybody.
Guys.
Thank you.